Okay. We are live. We are live once again back into the ether stream here. Welcome everyone. Welcome to the latest edition of Carolina Retirement Planners Happy Half Hour. Uh, I'm David Shakavage. I am the founder and president of Carolina Retirement Planners, and with me is my partner and daughter, Sam Shakavage, Samantha Shakavage. Say hi to everyone, Sam.
Hi.
Yeah, it's we are here. We are here. And if you're wondering what today's topic is, it's like, where has all the interest hiding? Why are we still not getting
Yeah.
interest on our savings accounts and all? We're going to talk about that and a lot of interesting things we discovered behind that. But we always like to start with fun. And speaking of fun, joining us here in the background and who you'll soon see is Amy, our director of client fun.
Hi.
And she's here for this special day. We do number if this is your first time, there's a number of things we do. One thing we do is we talk about what day it is. Every day seems to have a multiple things about it. What is today about, Amy? What is today special about today?
Today is National Mad Hatter Day.
Mad Hatter Day. Dang,
Yeah.
who would have thought, you know?
Look at us. I mean,
Yeah.
What?
So if you are out there and you're thinking we're crazy, well,
We're just mad.
There's a reason for this. There's a reason for this.
Yeah.
Like a baddest Mad Hatter hat, you know? And and so
I go back
uh,
over here.
you go back and take care of all that. We always like to say who's joined us, and uh, we have Bill with us and Brad with us. Sam, what are you drinking today? Are you drinking anything exciting on this suspicious day?
I am not. I'm just drinking water because I'm going to get off and furiously pack for a vacation to the lovely state of California tomorrow. So I can't fuzzy my mind with booze today.
Okay. And I'm, as
You're
usual,
good.
I'm drinking tea because when I'm done, I'm going to furiously race over to Brunswick Forest and give the second half of one of our retirement workshops. So that will always be fun. It was supposed to be last week, but we decided to postpone it because of that pesky storm that was coming by, and you just never know what to expect. So we thought better safe than sorry and delay it a week. So if you're going to be joining me there today, well, hi, and I look forward to seeing you there in an hour or two. So good fun.
Yeah.
Let's see, what else can we prelude? Have we got any other things that we haven't covered, you know?
We have people joining us. I don't know if you want to say some hellos.
Yeah, I would like to. Who we saw Bill, we've talked about Brad. We're running a little slow. We have to actually retype them in so we can see it. Don't ask me. There's one of the faults of this whole system. And Phil is here, and Teresa, who is a regular. And it's good to see you. It's good to see you. As well as Paul is here, and he wishes Sam you a safe trip.
Thank you. If anybody has any recommendations for the Redwood Forest, we're going to the Redwood Forest and Mendocino. I take any of those recommendations.
Yeah, not going to visit any wineries on the way, are you?
We are. We're going to do a brief tasting at Martinelli. We're not really visiting wine country, but we have a just enough time to stop in and do a tasting of Martinelli up on the way. And they make beautiful Pinot Noir. They have a really good Zinfandel. And so we're very excited about that.
No, that should be good. That should be good. And again, I see that that Brenda, our own Brenda, has joined us. She is saying hi, everyone. And Phil says good afternoon. Kristen, as our own Kristen, is here as well. Jean and Debbie, it's good to see you as usual. Al, welcome as well.
One of the things, if you want to talk about that we asked everybody is, since it is National Mad Hatter Day, was what was everybody's favorite character in Alice in Wonderland? So whether you read the book or any of the poems or anything along those lines, or if
Ooh,
not,
a match for dress.
oh yeah, or oh yeah, any of that. Watch the movies, cartoons, anything. Yeah, either way, you had a favorite character, let us know.
Well, whenever I was young, when I obviously identified with Alice, and now as an adult, I definitely identify and love the Mad Hatter. I think, as your perspective changes.
The Mad Hatter's great. Yeah. See,
The older and madder you get,
the older and madder you get, the more you realize that you are not the young protagonist. You are the mad one.
I like it. I'm a big fan of like the March Hare. I mean, that was my one. So.
We should probably get on with the actual purpose of our gathering today. I got to.
All right.
So
Dad, are you going to do the whole presentation with your pilgrim hat?
Please do. Yeah, I love it.
Well, by popular demand, I guess we'll. And today we're going to talk about rates. It's kind of weird. You've heard that Sam, what building is this?
Oh, that's the Federal Reserve.
This is the Federal Reserve. And you hear they've been raising the rates, right?
Yep.
And they're the ones that kind of the Federal Reserve has two goals. One is to keep us all employed, and the other is to keep inflation down. That's their formal things. And if in case you're wondering, this is the Federal Reserve. These are the 7 members of the Federal Reserve. We talked at an earlier one about them in more detail. But this is the current Federal Reserve. What year did the Federal Reserve start?
Wasn't it 1913?
1913. And in 1913, this was the Federal Reserve. And just in case if you're wondering, they sure have changed a bit, or become certainly more diverse, if you will, right? So this was 19. And one of the things they set is called the federal funds rate, and you can see let's talk about what the federal funds rate is, because a lot of people, you hear the federal funds rate, what does that mean? And each bank has some reserves. They have money that you've deposited there that they're not lending out at the moment. And they have some there. They also have some. This big one is the Federal Reserve Bank, and there's a bunch of them around the country. Earlier one, we actually showed the map, but they actually have some of their funds there as well. Well, this bank over here needs money, and so what it does is it borrows the money from these other banks from their reserve. And the rate at which they can borrow it is the Federal Reserve rate. And you can see that lately, this is 2010 here, and you can see from 2010 for several years it was essentially zero. Then they raised it a bit up to like 2.5%. It fell back down in 2020. They cut it again to zero, and now they've started it back up. And why do they do this? Well, it's because if it costs more for banks to borrow money to do things, they have to pass that cost along to all of us, and everything kind of goes up in cost. And we'll look in a minute how mortgages and credit card rates went up. And when things get more expensive, people buy less of them, And so if they buy less of them, the demand goes down, the price goes down, and inflation goes down, or at least stops. And you can see in 1980, you all remember 1980, the Jimmy Carter years, where things were really expensive. They raised the federal rate up to 20%. And you know, they did that because inflation for a decade had been too high, and they had to fix it. And so they went ahead and raised rates. I think it was Volcker, you know, really, really high. And now we've started that here. We started that here back up again, just so we can see it here. Oop, that's not right. You can see here, it still ain't right. Anyway, you can see here rates are going back up. Now, if we look at some things that happen when rates go up, one of the things that happens is things like mortgages go up. And this is a chart of what the rate of a 30-year fixed mortgage has been over time. And once again, back in 1980, when we drove rates up to like 20% on Fed rates, a mortgage peaked at 18%. If you went out to get a mortgage, right, it would be 18%. It's been kind of driving down ever since. And most recently, the 30-year mortgage rates got, you know, down to 3 or below 3 sometimes. So, yeah, to about 3. And now, since we've raised the Federal Reserve rate, it's doubled it this year from 3 to 6%. Big change. Now, what does that mean? That means, well, you know, it used to be at 3%, you could buy a lot of house. Now at 6%, you're not so likely to buy a house. And so there'll be fewer home sales, there'll be fewer lumber bought, there'll be fewer washing machines and all the new appliances bought. And over the last few years, we've had a lot of home sales, and you can't get lumber, you can't, you know, you order a house, you got to wait months to get your appliance. Well, if this goes down, then fewer people buying will mean the price of lumber will go down, the price of houses will go down. This was one of the sides. Now, of course, we'll sell less houses, and the economy will be less, but at least inflation should come down from the 8-9% increase we've seen over the last year. Another thing is the cost of credit cards go up. And I've been poking around the web, some Wall Street Journal articles, and earlier this year, the average credit card rate was something like 16%, and it's gone up to over 18%. So it's going to cost you more if you're running a credit card balance. And so you're less likely to go out and charge all that stuff and buy as much stuff and maybe splurge as much or take the fancy vacation, you know. So again, less demand should mean lower prices and a decrease. Car loans also. Car loans, you have an annual percentage rate. The stats I saw said it used to be less than 4% earlier this year, and now it's greater than 5%. So it's gone up by 25%, the price of cars.
Wow,
So
Dad.
again, people buy fewer cars. And boy, cars have been a big part of inflation. A lot of it due to chips and all. They couldn't get them, and you couldn't get enough cars and all that.
Do we have some silver linings coming soon?
No. Yeah.
Oh man.
Well, one of the things we all care, well, I don't have silver linings, but we have some advice on how you can overcome at least one of the dark clouds. And this dark cloud is interest. And
so maybe we can, so you're saying that maybe we can earn a little bit more interest to keep up with the price
well,
of
that's the problem. We should, but we're not. And what we have here is this is a graph. It goes up to about 2016, but some of the best data I could find. This again is from the St. Louis Federal Reserve. They put out the greatest little charts. And there's a blue and a green line here and a red line, if you can see it here. And the the blue line is again the Federal Reserve rate, and the red line is a 6-month CD rate. It's the rate for, and you can see they're tracking really close. It seems like whenever the Federal Reserve rate goes up, a 6-month CD interest rates, like the interest rates you get in your savings account or your money market or a CD, it goes up too. And sometimes, and when I look at it more closely in some of the others, often the CD is a little higher than the Federal Reserve rate. The trouble is, right now, CD rates, I went and I surveyed some CV rates. Corning Credit Union is the easiest. That's one of my favorite place to bank. Ooh, what happened to that? That's my favorite place to bank. I did have that here, didn't I?
I think whatever you're on is like a disappearing.
Oh,
You're in the wrong thing.
You're right. So the Corning Credit Union, if you go to them and it's real nice, you say rates, you go click, they show you the rates. Corning Credit Union, a 6-month CD is at 0.6%. Now the Fed rate, I think, is up over 3 now, but the Corning Credit Union is only paying 6. So I said, let me go to the Bank of America. Now, the Bank of America is not so easy. You got to go there, and then you got to put in your zip code, and then you got to put in this and all this, and you finally come up with a rate. And their rate for a 6-month CD was 0.03%. So that's about 20 times less than Corning Credit Union. And then I went to Truist, who I banked business-wise for a long time and will probably stop soon. And Truist, I'll be honest, I could not find the rate there. They had all kinds of stuff. You go ask for rates, you go right to the charts as rates. You could not find, maybe it might have to give them your address and social security number and everything just before they'll even tell you a rate. But I don't know what they're offering. And I always like to joke, if you've been on these before, is any bank that would change their name to Truist, you really got to wonder about. But anyway.
That doesn't seem good.
So as you may know from your money market, your bank accounts, interest rates remain really under 1%, close to, why is it they're not going up when the Fed rate is going up and mortgages have doubled and credit cards have gone up by 25%? Why are we not seeing higher rates like we have historically? And it has to do with savings accounts. See, a bank gives you more money because they need the dollars to lend out to other people. They have to make money. They pay us something on our CDs, maybe 0.6 or 0.03%, and then they lend it to us on our credit cards at 18%. And that difference is where they make their money. They don't want to make that difference any smaller than they have to. So if they don't need to, they don't raise the rates. Well, here is a graph. This is personal savings in the US from 1960 to now. And you can see in 2020 and it just zoomed up. It almost tripled, at least over twice as much personal savings. And if you go and dig through all the things, you find the total savings is something like $19 trillion. And it went up by $5 trillion during COVID. Now, where did we get so much money to put into savings during COVID? That's more than a rhetorical question. Do either of you know, where do we get so much money? Where did the average Joe get extra money to save?
Well, like, as in the checks that were sent that we're going to have to pay back, that just like the stimulus checks, is that what you're asking?
We had
it's not free money. Is that what you're asking?
Well, no, it was free money. We printed a lot of money and gave it to people.
But we're going to have to pay that back. It's not just like, we can't just keep printing money. That's not how it goes.
Individuals don't have to pay back exactly what they got. We all have to pay it back with taxes. But when COVID hit, we printed a lot of money and sent checks. I know many of you listening probably got a check during COVID because they sent checks to everybody of a certain income range. And they send checks and all that money. People got money. What do? They put it into their savings account, and savings went through the roof. So the banks now have more money than they need. They want, because they don't have, and they're tightening up credit because they're worried we may be facing, or in a recession, although not, we may be facing some rocky times here in the next few months. So they're being tight about how they lend money. So they're not wanting to lend it, and they got more than they need. So why should they pay us more for savings for our money? We got more than we need, and it's just, that's why we haven't seen the growth, is because the supply of money in savings accounts and money markets and the like that they can lend out is more than they have demand for. And so they don't have to pay us anymore.
Dad, I've been Googling while you've been doing this, and I think that you might be a little bit off about the current CD rates. You can get a 1 year, 12-month CD for about 3 to 3.5%.
Well, and where do you get that?
Discover, Barclays,
Yeah, so
Synchrony, Capital One, Live Oak Bank.
That's a good point. That comes to the next thing. We're sitting there earning nothing in our savings accounts. What can we do? And there's actually three, let me get the right one. There's actually three places we could put money. One of them is we can go to online banks, where we take our money and send it to an internet bank. And we'll talk about how they pay more and why here in a moment. We could also put it into fixed annuities called MIGAs. And we could also, one other thing, and it's kind of something that just came out really a year ago or so, and that is a specially designed life policy. Let me explain these three. When you're Googling that, if you Google best savings plan rates, you get, this was today. These are internet online banks. I think the first online bank occurred in like 1995. And you can get a just as plain savings account at 2.85% right now. You could get 2.85% liquid. These were about 0.5% earlier this year, but these places will offer you higher rates. Same way with a CD. You can go to them and get a CD at a greater rate. Now, why is it these online places offer better rates? And everywhere what I read is they have less overhead. You can't go to an office. They don't have an office. You got to do everything over the internet. Sometimes you can take money out through local ATMs of other banks, but it's a little cumbersome. You got to set up accounts. You got to give them your numbers to transfer the money and things. It's a little cumbersome, and people are lax to do it. Now they are FDIC insured. There's no, they're not risky in that sense. But a lot of people say, well, I had someone today say, David, I don't want to give my money to somebody that exists only as an online bank. But this is one place you could go, and you could probably, instead of getting 0.2% or whatever, you could get 2 to 3% at one of these in a money market, even more on a CD. So that is one thing. You just want to Google it really good and look for where's the best one and what's the best way to do it. And make sure if you're doing transfers over the internet, no one's absconding with your money. But it's all possible, and a lot of people do this. So that's the first place. The second place is in a thing called MIGA. Sam, what does MIGA stand for?
Multi-year guaranteed annuity.
Multi-year, the years here. Now, let's see here, son. You got the idea. Multi-year guaranteed.
I love the handwriting. It's so good. It's so good.
Um, and this is different than the annuities most people are familiar with. It's very much like a CD. You give them the money for X years, they give it back to you with interest. And you can buy several of them. You can get a 2-year. And Sam, if I bought a 2-year annuity, what's the best rate out there right now?
3.8%.
So you could get 3.8%. That means you give them the money, they're going to give you 3.8% a year for 2 years, and then you can take your money back or roll it over to another annuity. What other years? What else? You got any other numbers?
Yeah, a 3-year you can get 4.3%. And a 5-year you can get 4.95%.
So these are places, and the nice thing here is, you kind of, the entity, you're usually getting one of these through someone like us. And so you go face to face with someone that's making sure everything's going where it's supposed to go. And the other big advantage of these is these are tax deferred. So if you buy a CD, every year the interest off that CD, they send you a 1099, and you got to pay taxes on it. These, you don't pay tax on the growth until you actually take it out and spend it. So you do have, everything has its advantages and disadvantages, but this is another place that's been popular now because they can beat the prices at most of the regular banks and all that. And they're, generally considered very safe. It's like, so this is the third. And then the third one, and this is a little new. Let me get rid of this. This was a little new.
You got rid of everything.
And what happens here is you go and you put money in a life policy. Say you put $100,000 in a life policy. Now, unlike most life policies, you're trying to, and they are too, they built this product just as sort of a way to potentially gain growth. And what they're going to do is they're going to give you a death benefit on top of this. But if you put 100,000 in, your death benefit's going to likely be less than another 100. So you might have 150,000 in death benefit. But the nice thing is, and the reason you do it is, they take this money and they do indexing with it. They bet the interest on the market. And if the market goes up, say anywhere, you get the first, say 10% of interest, and they put it back in here. You got to pay your insurance cost, but you're going to get growth on this. And if you take the cost of insurance in the years where it doesn't earn, it's probably going to earn 3 to 4%. And it's also going to be tax deferred. You don't pay tax till you take it out. The other nice thing about this, even different than the annuities and the CDs, is you can take it out at any time. It only locks in once a year, but there is no, you're guaranteed. You put 100,000 in, you can get 100,000 out anytime. If you get growth after a year, you can take that out as well. So they built something that's got a kind of a cross between a indexed annuity and a CD, and
if you die unexpectedly, there's a death benefit to it as well.
And if you die, God forbid you die, the death benefit. And they're very simple underwriting. And so this is another place. If you're sitting on a few hundred, I know people are sitting on hundreds of thousands of dollars and they just don't want to put it in the market. But especially now with inflation, what it is, it's shrinking and shrinking. Anything you do to recapture some of that inflation would be good. So these are the three places we could go to overcome this. Here's why we're not making any money most places, is because they don't have to. They got more money, and three places you can go to get more. And that's just a reminder, if you have some questions, our clients know they can always call us. But if you're out there, our website is at Carolina. You can, no, that's not, boy, this is an old one. our website's at Carolina Retirement Planners.
I got you. I put it in the comments. They could just, they can follow the, it's all good.
So, so that is our little presentation for today. And where is the interest gone? Who stole the interest? And I hope this was helpful. So, next week we're going to have, while Sam is off on a vacation, I'm going to be talking to Jonathan Taylor above us about we're kind of in that Medicare time when you can change
Open
things.
enrollment.
And he's going to talk about the ins and outs of open enrollment, and it's going to be really good. I've learned a lot talking to him. I've been teaching things now in my workshops that I've learned from Jonathan, and then the week after that, we're going to talk about hidden taxes in your retirement, taxes you may not even know about that you may be paying. So that'll be fun as well. Okay, but we are at the top of the hour. We got to get going. What do we do next, Sam?
We have somebody here.
Oh,
hey, Declan. Also wearing a cool hat.
He is, celebrating Mad Hatter Day. So yeah, my grandson's here. So say hi.
Awesome. Hey. Well, if you were here with me, I'd let you pick the name out of the bucket, but
he would love it.
Well, sometime soon we'll make that happen. But so each week we give away 2 bottles of wine delivered directly to your door from Fermental Bottle Shop. They are newly located in the Cargo District in downtown Wilmington. And all you have to do to enter is each week we put out a little event and you just click, I am going to that event if you are a member of Facebook, and we also will shoot you out an email letting you know what the topic is. And if you respond to that email and let us know you want to get into the wine drawing, or let us know what your favorite character from the Alice in Wonderland is, or whatever cool question Amy puts out there, we will get you entered in as well. And if you share either of those with a friend, we will get you in another time. So there's a lot of ways to name in here. And our winner this week is
officially
Linda A.
Linda.
Linda
congratulations.
So congratulations, Linda. You are our wine winner. We will be in contact with you to get you.
Tip of the hat to Linda here,
Tip of the hat.
Yeah.
To get your 2 bottles of wine. So congratulations.
Yes, thank you. We're so excited. Sam, you have a wonderful trip.
I will. I'm so looking forward to it. I am looking around and I have so much to do right now to get there. I don't know how it's good. I don't know how I'm going to make it, but
you're gonna make it, because it's going to be wonderful. So have a wonderful time.
I will. Thank you very much.
Everyone, have a good week. Cheers. And we will see you next week.
Yes, can't wait. Take care, everybody. Bye-bye.